Alibaba recently announced earnings for the first quarter of their fiscal year 2024, which is the second quarter of the year. We can see their stock is basically breaking even over the last 12 months, while the rest of the market is up 5%. So Alibaba is slightly underperforming the market over the last year. And so in this video, I'm going to look into some of the recent news that came out surrounding not only Alibaba, but also the whole economy in China as well, which is pretty interesting right now. I'm also going to look at their financial statements and then use a discounted cash flow model and figure out the weighted average cost of capital for Alibaba to figure out the intrinsic value per share for this company. So right here we can see in this article, it's titled 2 Reasons Investors Should Still Be Wary of Alibaba Stock Despite Recent Revenue Increase. Some key points they touch on: Alibaba returned significant revenue and earnings growth, but their status as an American depository receipt listing makes it vulnerable, and China has had difficult relations with both Alibaba and US regulators in the past, and they still do at the moment. Right now, they touch on the fact that there was a double-digit increase in net sales, massive profit surge, and also an increased emphasis on AI, which shows that Alibaba might be positioned for a comeback. In terms of their earnings report for their quarter, they showed that in the second quarter of 2023, they basically had $32 billion in revenue, which rose 14% from the revenue they had in the second quarter of 2022. Operating margin 18%, up 12% from a year ago. And then also they had net income of $4.6 billion, which is up 63% year over year. So very impressive revenue and earnings growth for Alibaba. Right here, they point out CEO Daniel Zhang pointed out that it's possible that Alibaba might break themselves up into 6 different companies under different umbrellas, and the sum parts of these 6 different companies could end up being worth more than the whole and significantly benefiting shareholders. So that would be a pretty big restructuring for the company. Obviously, they would split up all of their interests and they'd be able to focus on those 6 business sectors as opposed to having it as one giant conglomerate. Right here, they point out a few reasons why you should avoid Alibaba's stock. They point out that obviously Alibaba trades on American stock exchanges as ADRs, American Depository Receipts, which is actually stock in a Cayman Islands-based holding company that issues legal certificates representing an interest in Alibaba. But this is a danger to investors, as well as the fact that there's a lot of political turmoil between the US and China. There has been a lot of recent news that's come up surrounding other reasons why it might not be as favorable for investors to invest in ADRs, including the fact that they might get delisted from the Securities and Exchange Commission. So there's a lot of risk there when we're getting involved with Alibaba. Those are a couple of the reasons why Alibaba is currently trading at only 20 times earnings compared to their competitors like Amazon, which is at 110 times earnings, and Mercado Libre, which is at 87 times earnings. Those are both e-commerce competitors for Alibaba. The uncertainty, it probably explains why 9 years after their IPO, they pretty much haven't really returned any value back to investors. They gained about 230% at their all-time highs, but since then we can see that since going public with their ADRs, they've basically broken even since 2014. So that's obviously really not good news for long-term investors in Alibaba, who at this point are losing money if they bought Alibaba at the IPO date. Second reason to avoid Alibaba is just mainly because of China, the tenacious relations with China and their communist regime and their economy. They point out right here that former CEO Jack Ma disappeared for months after criticizing the Chinese government, an action that coincided with regulatory crackdown on his businesses, and this ended up leading to a cancellation of the initial public offering of Ant Group, a mobile payments platform in which Alibaba held an investment. Right here, they point out that American and Chinese relations have become more contentious amid leadership changes in the Chinese government. And this key point right here is really important. A lot of U.S. companies have begun to move manufacturing out of the Chinese economy. And obviously, manufacturing is huge in China. So the fact that a lot of companies are starting to weigh the risks against the rewards and believing that it's not really worth it to manufacture in China is a pretty big deal. And we're actually going to get into that a little bit more later in this video. Right here earlier, like I pointed out, the SEC has warned that there could be a delisting if the agency isn't able to review audits of Alibaba's company's financial statements, but they withdrew this threat when they gained access to the audits. But the fact that this threat still lingers is very chilling, has a very chilling effect on potential investors in Alibaba who might not be willing to take on the risk that their ADRs could eventually maybe get delisted. So while it looks like you could buy massive growth at a low valuation for Alibaba, they've experienced a total reversal of their all-time gains in a relatively short time period, as we can see right here. And the fact that there are tenacious relationships between the US and Chinese governments also really doesn't help make the situation any more stable and any more attractive for investors. So to touch on that fact about companies moving manufacturing out of the Chinese economy, I have an article right here that's really detailed, talks about a lot of companies that are moving their manufacturing out of China and how that's affecting the global economy. Right here, they touch on that for decades. China has been known as the world's factory. They became a major manufacturing hub in the late 1970s and early 1980s following the country's economic reforms. And these reforms opened China's economy to foreign investment, making companies, and many companies began to outsource their manufacturing to China. Historically, a lot of the reasons why manufacturing was outsourced to China was due to low labor costs. China had a large, relatively young workforce, and labor costs in China were much lower than in other developed countries. Government support: the Chinese government offered a lot of tax breaks, subsidies, and other incentives to attract foreign investment. Infrastructure: they built roads, ports, and airports to make it a lot easier to transport goods in and out of China, which is essential for manufacturing. And also technology. China has a really strong technological sector, and this has helped maintain the country's position as a competitive manufacturing entity. But more recently, companies and people have been weighing the risks against the rewards, and they've felt that it might not really be worth it, mainly because the companies may face quality control issues, intellectual property theft, and political instability. And so many businesses have found that the risks might not be worth taking. A growing number of companies right here, as we can see, are moving their manufacturing out of China. The trend is being driven by a number of factors, including rising labor costs in China, the ongoing trade war between the US and China, and concerns about political and economic stability. Some companies that are moving their manufacturing out of China include Intel. They're considering moving it out of China to the US to comply with US government regulations. Microsoft from China to Europe to reduce supply chain risks. Nike from China to the Southeast Asia to improve quality and reduce costs. And then Dell Computers moving it to Vietnam and Mexico to reduce costs and improve efficiency. Some countries that are taking advantage of a lot of these companies' shifts out of China are Vietnam, India, Mexico, Indonesia, and Bangladesh, because these countries offer lower labor costs, a more stable political environment, which is really crucial, and then also closer proximity to major markets. India is one of the main players in this game. In particular, they want to increase their economic and production output. In recent years, the Indian government has taken steps to really make India a country that's very attractive to foreign investment by reducing taxes and regulations on businesses, investing in infrastructure like roads, ports, and airports, and just all around making it easier to invest in India. As a result, in 2022, India's GDP grew by almost 9%, the fastest pace of growth in any major economy. In 2020, Prime Minister Modi said that India's goal was to become a $5 trillion economy by 2025. Right now, they're about a $3 trillion economy. And to put that into context, I believe the US is about a $27 or $29 trillion economy, something like that. Apple is one of the main companies that has really started to move their manufacturing out of China and into India. In 2022, Apple tripled their iPhone production in India. The Indian government offered Apple a number of incentives to move to India, including tax breaks and subsidies. They provide a large and skilled workforce to manufacture Apple's products at a very low cost. And then also, India is a growing market for Apple's products, and Apple believes that if they manufacture their products locally in India, they'll be able to increase their sales in India as well, which will obviously increase sales overall for the business. Lastly, right here, they point out that a lot of companies should start looking for ways to reduce their dependence on China for manufacturing. China's obviously still the factory for the world, but it's becoming increasingly difficult and expensive to do business there. And by nearshoring or homeshoring their manufacturing, companies can de-risk their exposure and improve their net profitability. So very interesting news coming out for why companies are moving out of China, and that's obviously very indicative of the instability there politically. And we can see that right here just physically from Alibaba's decline in the stock price. This all came as a result of China's governmental intervention into Alibaba's growth and innovation. And so a lot of companies see that and they're not willing to take that risk. So right here, these are Alibaba's financial statements. We can see that revenue came out to $32 billion, which is up 14% year over year. And then net income came out to $4.5 billion, which is up 63% year over year. For page 23 balance sheet, we can see total assets came out to $245 billion. So it's obviously a very big business. And then total liabilities, $86 billion, total equity, $156 billion. And then of that, they have retained earnings of $85 billion. And lastly, right here on page 25, they have a condensed cash flow statement. They don't go too much into detail right here, although I am going to provide the details in a second. Operating cash flow was $6.2 billion, and then they use about $3.3 billion in their financing activities. And we can actually see on page 18, if we go there, that they point out in financing activities of the $3.3 billion that they used in financing, they used $3 billion to repurchase ordinary shares of Alibaba. So they did prioritize returning value back to shareholders. On top of this, I know it's not listed here, but Alibaba had free cash flow of $5.3 billion on their cash flow statement, which is up 76% year over year. So pretty impressive cash flow increase for Alibaba. Hopefully they'll be able to continue that momentum into the future. And then obviously that coupled with improved economic political stability in China might end up making Alibaba a more attractive buy for investors. Okay, so right here, this is the discounted cash flow model for Alibaba. I'm using a growth rate of about 10%, and I got that right here from this historic growth rate calculation. Alibaba had free cash flow of $15 billion in 2018, $24 billion in their most recent full year in 2022. So that comes out to a historical growth rate of 9.82% compounded annually over the last 5 years. That's how I got this metric right here. Weighted average cost of capital came out to 6.3%. I got that by using this calculation right here. We see book value of equity is a lot higher than debt, $162 billion to $91 billion. Interest rate on their debt was about 3.6%. Effective tax rate on average is about 17%. So we're able to use the risk-free return added to Alibaba's beta, which is 0.68, which shows how volatile Alibaba is compared to the rest of the market. And then we can multiply that by the average stock market return, 10%, minus the risk-free return, 4.25%. That gives us the cost of Alibaba's equity, 8%. Equity proportion, 64 compared to 36 for debt. So weighted average cost of capital is the equity proportion of 64% times our cost of equity, plus the debt proportion times cost of debt, multiplied by the tax yield, which is 1 minus the tax rate. That gives us Alibaba's weighted average cost of capital, 6.3%, which I use to calculate the discount rate to discount Alibaba's future cash flows to their present value. We can see free cash flow for the first year I'm using for this model is $24 billion, which is what they had in 2022. Net cash minus net debt on their balance sheet comes out to be about $52 billion, and they have about 2.5 billion shares outstanding. These metrics in mind means that their intrinsic value per share is estimated at $210 per share, which means that at the current share price, they're currently definitely trading below their intrinsic value per share, which is not surprising given the fact that their stock price has been knocked down so far, as the article pointed out. But keep in mind, although they are currently trading below intrinsic value per share, Alibaba is a very unique case study because they are obviously not a U.S. company. They're a Chinese company, and China's government is mainly responsible for this massive decline in the share price. So it's true, if you buy into Alibaba right now, you are buying the company below intrinsic value, but that doesn't necessarily mean that the company is going to increase from here in terms of stock price, because there are a lot of other moving variables to consider when you're looking at Alibaba. So right here, this is a competitor/industry analysis. I compared them to two of their American competitors, Amazon and Walmart. These are all like major retail and e-commerce companies. We can see that for profit margins, Alibaba is pretty much blowing Amazon and Walmart out of the water. They have a higher gross profit margin, net profit margin. basically same return on assets as Walmart. They have a lower return on equity compared to Walmart, but they also have a lower debt to equity ratio. They don't take on nearly as much debt as Walmart does, although none of these companies really take on that much debt. And then we can also see that for price to earnings ratio, Alibaba is trading at a much lower price compared to their earnings in comparison to Amazon and Walmart. Obviously, that is very indicative of the political instability in China, as I've touched on many times in this video. And then Alibaba does not pay a dividend. Walmart is the only company that does that, with a 1.56% dividend yield. So for every $100 you invest into Walmart, you're getting paid $1.56 in dividends per year. So based on this, it looks like in terms of just, if you were just going to judge these companies, just isolating them based on financial ratios, you'd probably want to give it to Alibaba because they're trading at the cheapest price to earnings ratio while also having the highest profit margins. But obviously, as I've touched on many times in this video, this is not the only thing to consider when looking at Alibaba. Okay, so the last thing I wanted to do in this video is compare Alibaba to the other companies that I've looked at in past videos on this YouTube channel. We can see that in terms of share price to intrinsic value, Alibaba comes in 6th place with a current share price of around $88, with an intrinsic value per share coming out to $210 per share. That means they're currently trading at 42% of their intrinsic value per share. Right now, Occidental Petroleum, ExxonMobil, AMD, Chevron, Google, Albertsons, and Etsy are the only other companies we've looked at in past videos that are also trading below intrinsic value per share. We can see right here that for growth rate, Alibaba's growth rate was only about 9.8%, not good enough to get them onto the growth rate table. AMD holds the highest spot at 83%. For profitability, we saw that Alibaba had profitability ratios of about 30% and 10% for net profit margin, not good enough to get them onto either table. Adobe and Occidental Petroleum hold the top spots for gross profit and net profitability. We can see that for dividend yield, Alibaba doesn't pay a dividend, so they obviously don't make it onto this table. Intel has the highest at 5% dividend yield. For a second quarter year-over-year revenue and earnings growth, we can see Alibaba comes in 7th place for revenue with 14% year-over-year second quarter growth for revenue, and then 63% year-over-year second quarter earnings growth. So that's pretty impressive. They're definitely doing a lot better than a lot of the other companies we've looked at. But first place for year-over-year revenue and earnings growth goes to Tesla with 47% revenue growth, and then Intel with 400% earnings growth. Lastly, for stock performance over the last 5 years, it's no surprise that Alibaba does not make it onto that table because they're down 48% over the last 5 years. Right now, Tesla has the number 1 spot with a 1,100% return over the last 5 years. So based on this, it looks like Alibaba is pretty competitive in terms of second quarter revenue and earnings growth, and also for intrinsic value per share. But for every other table, they are not good enough to be competitive with other companies that we've looked at. For competitor/industry analysis, it looks like Alibaba, based on these financial ratios alone, is doing a lot better than Amazon and Walmart. And then for intrinsic value per share, for the discounted cash flow model, it looks like Alibaba is definitely trading below intrinsic value per share at the current share price. So let me know in the comment section down below what you guys think of Alibaba. This is a very unique stock, and I like to keep my eye on it for 2 reasons. One, because it's a potentially very good opportunity, but also because it helps me keep up to date with all of the economic news that's happening in China, and I like to share that with everyone who watches the videos on this channel. So leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.